Welcome to chapter 12. We're almost done. We're in the home stretch. I hope everyone is getting through the chapters as well as they need to. And please contact me if you have any questions. But let's talk to chapter 12 and get it going. Chapter 12 is a big one. Chapter 12 talks about the cost of production and why do we examine the cost of production and how it benefits firms on the micro level mainly and somewhat on the macro level. So we'll talk about chapter 12 and we'll talk about how it develops cost curves on the firms and how the firms use the cost curves to have their behavior to get in and out of markets. You will see the graphs and the formulas inside chapter 12, and I want you to be familiar with them, I want you to see them, but however, I want you to be more aware of the concept, why they're used, and how they use those formulas to make predictions and assumptions, and not necessarily want you running the formulas. I want you to understand the importance of the function of those formulas and how they tell firms to step in and step out. The remaining chapters 13 and 14, we'll utilize these to talk about the cost curves as well, to how they develop the behavior of the firm in many different market structures, competitive and monopolistic firms as well. So the purpose of chapter 12 is to address the cost of production and the development of firms' cost curves. These cost curves underline the firm's supply inside the curve and whether or not they decide to produce more or to cut back. In previous chapters, we summarized the firm's production decisions by starting with the supply curve. While this is suitable for answering many questions, it's now necessary to address the costs that underlie the supply curve in order to address the part of economics known as industrial organization. This is the study of how firms' decisions about prices and quantities depend on the market's condition that they face. So, let's start out by taking a look at total revenue, total costs, profits, and their functions, and how we go about measuring those. So let's talk about the book's definitions. First of all, total cost, which is the market value of inputs and the firm uses in production. Profit, total revenue minus the total cost. Total revenue, which we know is the amount of the firm receives from the sale of the output. So then we flow into, as your PowerPoint should talk about, the cost of opportunity cost. We talked about our opportunity cost way back in chapter 2. And so we're reminded here that opportunity cost is the cost of something for what you're willing to give up to get it. The cost of a production of an item may include all the opportunity costs, the inputs, all the things that we've talked about used in production for that total output. The total opportunity cost will include both implicit and explicit costs. The definition for explicit cost is input costs that are outlawed the money by which the firm has to have to require. The implicit costs are input costs that the firm do not require an outlay of the money by the firm. So the total cost of the business is the sum of the implicit cost and the explicit cost and the implicit cost. This is why we have two different viewpoints. Viewpoints from accountants and viewpoints from economists often differ because they analyze the performance of businesses in different types of ways and use different formulas. Accountants focus mainly on the explicit costs, while economists focus both on explicit costs and implicit costs. We also have to find the opportunity cost. The opportunity cost is an important part of the cost because in any analysis it predicts the firm's performance and also helps us in making assumptions. So let's give an example. An example I believe is in your PowerPoint, and if not, it's in your book. Caroline uses $300,000 of her savings to start her firm. It was originally was in her savings account, earning 5%. Because Caroline could have earned $15,000 per year in her savings just off of the interest, we must include those as opportunity costs. Note that probably an accountant would not see that as an opportunity cost and would be part of the firm's cost. If Caroline had instead borrowed $200,000 from a firm or from a bank and $100,000 from her savings, the opportunity cost would change if the interest rate stayed the same or if it moved depending on the accounting in an economist. But the accountant now would count the $10,000 interest from the bank from the loan and her overall revenue or cost. So we have to look at if we're looking at how accountants view the business plan versus how the economist views the business plan. We'll talk about both the production function and the marginal function. Accounting profit, as we know, is the total revenue minus the total explicit costs. If input costs are greater than 0, accounting profit will always exceed the economic profit. So we talk about production and marginal production. The relationship between the quantity of inputs used to make a good and the quantity of the output of that good. So the definition for production function is the relationship between the quantity of the inputs and the quantity of the outputs of that good. When we look at marginal production, it is the increase in the output that arises from additional unit of input. So the more we put in, what is the marginal production of what we get out? So we talked about the production function and the relationship between the quantity of inputs used to make a good and the quantity of the output of that good. We talked about the marginal product, which is the increase in output that arises from additional unit of input, and also the diminishing marginal product, which is where the property whereby the marginal product of an input declines as the quantity of the input increases. So as you'll see as we move forward in chapter 12, you will see a lot of figures in your PowerPoint and in your readings. You'll see graphs and diagrams. You'll see the curves and the slopes. You won't have to worry about figuring out a formula, but I do want you to be familiar with them. I do want you to see them. I do want you to try to follow along with the best that you can. So be familiar with the concepts, the terms, and the vocabulary, so that when you do see them down the road. So don't get worried about getting lost in the numbers, but do try to look through your PowerPoints and do go through your reading so you can kind of have a general grasp of it. So as we move on, we start talking about the graphs and some of the things we're going to do to describe the curves, and so we can make predictions from those. We can use the graphs of the firms when we talk about the production function by looking at the levels of labor on the x-axis and also against the level of output on our y-axis. So as you can see in your graphs, the slope of production function measures the marginal product, and the diminishing marginal product can be seen from the fact that the slope falls as the amount of labor increases. From the production function, we can see that the effects of the total cost curve. We could draw a graph, or you probably have a graph on your PowerPoint, that show the firm's total cost curve by putting in the level of output, of course on the x-axis, against the total cost of producing the output on the y-axis. So the total cost of cost curve gets steeper and steeper as the output rises. The increase in the slope of the total cost is also due to diminishing marginal product. As we talked about earlier, you can see an example of Caroline borrowing money to start her business and what she would have received if she'd used it to make interest rates. Look through that graph and see if you can kind of follow along on that figure. I'm not sure which one it is, but look through your PowerPoint presentation. So now let's talk about fixed costs, variable costs, average total costs, average fixed costs, variable costs, marginal costs. And as you'll see, your paragraphs in your books abbreviate these a lot. So just try to follow along with them the best that you can. You can always refer back to them to see which ones are. But first, let's talk about fixed costs. Fixed costs are costs that do not vary with the quantity of the output produced. So it does not change. The more you put out, fixed costs do not change. Variable costs do vary with the quantity of the output produced. So the more you put out, variable costs do change. Total cost is equal to the fixed cost plus the variable cost. So to find total cost, we take fixed cost and variable cost, add them both together. If we look at the definition for average total cost, it's the total cost divided by the quantity of the output. If we look at the definition for average fixed cost, it's fixed cost divided by the quantity of the output. As you move forward, you'll see the book begins to refer to them as ATC, AVC, AFC, and FC and VC for the other ones. So just make sure you kind of have a good use of those terms and what they're used for. When we talk about the average variable cost, it's the variable cost divided by the total quantity of the output.